Hello, and welcome back to Financial Analysis for Nonprofits. This week, we are talking about understanding our operating performance. This question of, are we living within our means? The answer to this question sits on our statement of activities, better known as the income statement. So we're going to dive a little bit deep into this financial statement this week. Again, understanding operating performance. I believe it was chapters 8 and 9 that you should have had read for today's presentation. And so when we're thinking about the income statement. Now I know, one of the things I forgot to mention last week, and I'll just say it this week, is that I get that people are in a lot of different kind of levels of understanding of nonprofit financials. Some of you may be CPAs and accountants, and you do hard balance sheets, and you're fantastic. Some people may be brand new and be like, "What's a balance sheet?" Right? And there's a lot of probably of you in the middle there somewhere. So one of the things is, I think everyone's going to get something out of this. For the folks that are newer to nonprofit financials, you'll understand some key terms, understand some, what are these financial statements trying to say. For those who are more the experts and you already know that, this may be more around how do we translate that information for non-financial board members and staff, right? How do we talk about financial story in programmatic terms? And so for a lot of this may be giving you some tools or analogies or things that you can hopefully better explain some of the financial issues to staff that don't live in this world on a day-to-day basis. Now, throughout this course, we're going to be using a couple different case studies. The main one I'm going to be using for the next couple of weeks is Homeboy Industries, Los Angeles-based organization. I'm going to be using their audits from a few years ago because I don't want to deal with kind of current relevant stuff, but the financial statements are financial statements, and what year we look at doesn't have any impact on our ability to analyze those documents. And then for a lot of the homework assignments and the quizzes that we'll be having, we'll be using another LA-based organization called Tree People. Now, I have used publicly available data. You can go on to GuideStar, you can go onto their website, you can get this information. You Google Homeboy audit, you'll probably, this will pop up. So I'm not using any proprietary information or anything that's confidential in any way, shape, or form. This is all publicly available data. But online, you have the links to these resources and tools, but we'll be using them in the presentation. But if you want to kind of take a deeper look, and there'll be sometimes when we're talking about, reading, kind of going in deeper and some of these for some of your homework assignments. Now, last week, remember I talked about the 3 key questions that we're going to be focusing on in this course. Today, we're focusing in on this first question about operating performance. And whenever you hear me talk about operating performance, I'm talking about surplus deficit. Did we bring in more money than we spent? Right? Are we making ends meet? And that's really what we're going to be focusing in on today. All right. One of the things I mentioned last week was this idea that we have 4 names for everything. Statement of activities, better known as the income statement, sometimes called the profit and loss, sometimes called the P&L. So if you hear P&L, profit and loss, income statement, statement of activities, it's all talking about the same document. Now, I want to cover a couple key terms on this document because it does matter in terms of how you're looking at and understanding them. One, you'll often see this term called support on audits and other financial documents. What they're talking about, whenever you hear that term support, you should think contributed revenue, donations, whether they're from individuals, government, foundations, corporations. This is money we're going to give to you, and then you're going to be able to take this money and go ahead and deliver your programs and services. Now, if you see the term revenue, what they're talking about is earned revenue, ticket sales, right? Fee for service contracts, investment income, all of these other, there's some type of transaction. If I'm buying a seat at the opera, right, I give them the money, they give me my seat. I'm not just donating it to them to do whatever they want. There's some kind of exchange. I, as a customer, am getting something of value for that. But the organization hopefully has built in their profit margin into those numbers. So they're using that to support the long-term sustainability of the organization. but revenue is earned revenue, transactional, versus support is donations. Now, you will see this term called net assets released from restrictions. And now this is where nonprofit accounting kind of goes off the rails, because this does not exist in the for-profit world. If you go and look at for-profit financial statements, you will not see net assets released from restrictions. This is only something that happens in the nonprofit sector. So a lot of times when people come over from the for-profit world, this confuses the heck out of them. But basically, and I'm going to talk about it in a slide or two, it is money that we have raised in previous years or previous periods that we get to spend today. And I'm going to go into a little bit more detail on that. Then we have our expenses, typically broken down into those not very helpful categories of program, management in general, and fundraising. Again, no clear definition of what each of those categories are, what's a program and not program expense. And we could argue on that until the cows come home, because there's just no standard definition of that. And that's why we have that statement of functional expenses, because then it takes those categories that are kind of arbitrary and puts them into our more traditional, better defined. We know what salaries are. We know what employee benefits are. We know what our utilities are. We know what office supplies, very clearly defined in our statement of functional expenses. Then, of course, we have what we call our change in net assets. We often talk about surplus or deficits, but you won't see that term on audits or 990s. And so this is, if we bring in more money than we spent, we have a surplus, which actually increases our net worth. So it's an increase in our net assets. Again, if we have a deficit, meaning we spent more than we brought in, that money gets pulled out of our savings and our net worth drops, or there's a decrease in net assets. So change in net assets is your surplus or deficit. Increase in net assets is a surplus, decrease in net assets is a deficit. But you will not see surplus or deficit on most financial documents. Definitely not audits or 990s. All right, so that term net assets released from restrictions, right? What is that really talking about? What is this concept of restrictions? Now, basically, you can't do that. You can't place restrictions on money that you use in the for-profit world, right? If I buy stock at Starbucks Corporation, I can't tell Starbucks, well, I only want this money to be used to produce Frappuccinos in Los Angeles. No, they're going to take that dollar and do whatever the heck they want with it, right? I don't have no say around how they use the money that I give them. Or when I'm buying my latte at Starbucks, I can't say, I want all of this money to go to the barista. It doesn't work that way. But in the nonprofit world, donors, funders can restrict their dollars. What does that mean? It means they tell you when or where you get to spend that money. So there are a couple different categories of restrictions. And then the accountants put wonky names on it that confuse the heck out of everybody. So we have what is called, technically, the formal accounting term is without donor restrictions. Most people refer to this as unrestricted revenue, right? This is money that comes in, general operating support, core operating support, earned revenue, right? This is money that comes in. When the dollar comes in, we can do anything we want with that dollar. We can spend it on programs, we can spend it on overhead, we can put it away in the bank for tomorrow. That money is ours to do whatever we want with it. Then, but oftentimes donors put what is considered a temporary restriction. And I'm going to kind of imagine this as our cookie jar over here, right? We have the dollars in this kind of cookie jar that eventually we'll be able to get to them. But right now they're set aside. And the formal accounting term is with donor restrictions held for purpose or timing. Now, what's a purpose restriction? That's easy. That's a program, right? This can only be spent on your after-school program. This can only be spent on your immunization program. This money can only be spent within Los Angeles County. Whatever that is, they put some type of purpose or program restriction on what those dollars can be used for. or there's a timing restriction. Most often, this is a multi-year grant. If I give a nonprofit $100,000, but as a donor, I can say, well, I want $50,000 for 2022, but you have to save the other $50,000 for 2023. So I can tell the nonprofit when they get to spend that money. And so that money that sits aside for 2023, well, that gets put in this cookie jar right here. And it just sits until January 23. And then the nonprofit can finally access those dollars. So the other classification of restrictions is called with donor restrictions held in perpetuity. Woo, fancy word, huh? We call this our endowments. These are our permanently restricted funds. And I'm going to kind of illustrate that as a safe, right? That money gets put into there and you can't get into access to that. It doesn't come back out. Unlike the cookie jar where we can eventually get this money is put aside for perpetuity, AKA forever, right? Even if the nonprofit goes out of business, they cannot access these funds. If the nonprofit closes its door, the state attorney general comes, takes those funds and gives it to another nonprofit doing similar work. Because what they're trying to meet is donor intent. If I gave you $1 million to deliver after-school programming for at-risk youth and you go out of business, they take that money and give it to another nonprofit doing after-school programming for at-risk youth to match what the donor intended those dollars to be used for. So we have our unrestricted money that we can use for whatever purpose we need. We have these temporarily restricted funds that we have to either spend on specific programs or in specific time periods. And then we have our permanently restricted money that's locked away forever and ever. Now, the thing that's happening on the statement of activities or the income statement is money moves between these buckets. So let's take a look at this cookie jar. And let's take that example of that multi-year grant. So I gave this nonprofit $100,000 and I said, 50,000 you can spend this year. And so that sits in this pile and they get to spend it. I said, the other 50,000 has to wait until 2023. So what happens when January 2023 rolls around? Well, the nonprofit can then take that money out of the cookie jar, move it over and plop it in the unrestricted bucket and spend it on whatever they needed to spend it on. Or if it's a program restriction, once you start incurring expenses on that program, you can take the money out of the cookie jar. Say you get funding for your summer camp. Well, once you start hiring your counselors and getting your vans and putting deposits down on the space, that means you have met the restriction, which is that this money is only being used to cover expenses that are directly related with your summer camp. Or now, if you got programs that are ongoing throughout the year, you might be able to release these funds over a period of time. You know, we have grants that we can release the money every single month because our programming goes all 12 months. And so we take a portion of it and we release it every single month. So maybe it's being released monthly, maybe it's being released quarterly. It may be released in a particular period, like a summer camp, or if it's a multi-year grant, again, at the start of the fiscal year, you generally can release those dollars. Now, what about that money that's over in our safe, our endowment, our permanently restricted funds? Well, while we can't access those funds, we can invest them, and any interest that we get off of those funds, that interest we can use to help cover operating expenses, right? So if we have this big endowment and it's generating $3.87 of interest, which would be good right now because the stock market's been tanking over the last few months and most people have been losing money. But if you have any interest income off of that, that is considered earned revenue and it moves into your unrestricted bucket. Now, you see money coming from the permanent restricted interest coming in. You see money from that cookie jar coming into this middle bucket, this unrestricted without donor restricted pile. Why is all the money flowing into that bucket? Well, because all expenses have to be paid with unrestricted dollars. Can you pay your salaries and your light bills with money that's set aside in the cookie jar for 2023? No, that's set aside. You can't spend that today. Can you pay your salaries and your light bills with money that's in the safe? No. You can pay it with any of the interest income, but the money that's in the safe, the principal, can't touch it. The corpus, they sometimes call it, that money you can't touch. So we can't pay our operating expenses or salaries or light bills or office supplies with money that's in the safe. We can't pay it with money that's in the cookie jar. It's only this pile of unrestricted dollars that we actually get to spend. Now, you'll see what that does to our accounting and trying to get at this answer. Are we living within our means? All right. Woo. So what I have up on the screen is the statement of activities or the income statement from Homeboy Industries. Again, the audit, the full audit with all the notes and the cover letters and everything else is online, and you can have access to those. I just pulled out the statement of activities just for the purpose of today's presentation. So a couple things let's look at first. One of the things is, again, they kind of lump everything together as revenue, but if you notice, this first line is grants and contributions. That's our contributed or our support. So all audits and 990s and most financial documents differentiate between contributed support and earned revenue. They always separate those two things out. And in this case, we see they do that as well. We have our grants and contributions here. We have our government contracts. We have sales of, the Homeboy runs the Homegirl Cafe. You can buy shirts and hats and all kinds of stuff from them. And then there might get some other income as well, rental income, interest income, we don't know. And then we see the net assets released from restrictions. All right, so here we have our revenue, we have our expenses, and we have our bottom line, our change in net assets, our surplus and deficit. And what we have here is, you see, this is for fiscal year 2015 on the left, on the right is fiscal year 2014. And we have our different categories. Without donor restrictions, that's our unrestricted, and then our with donor restrictions. These are temporarily restricted. Homeboy, at least at this point, did not have an endowment. They don't have any permanently restricted funds. And then we have a total column. So when you first look at this, man, there's a ton of different numbers, right? There's numbers all over this place. And if I said, well, how did Homeboy Industries do? You'd be like, where am I even going to look, right? So if I ask most people, how did Homeboy Industries do in 2015? Most of us, if you just hand it out to the person on the street, what they're going to look at is this total column, right? They're going to see that Homeboy, if you look at total revenue, you see 16.2 million. Oh, let me get out my little laser pointer again, right? So we see this 16.2 million right here in total revenue. We see 16.5 million in total expenses, and it shows that Homeboy has a deficit of $298,000, an almost $300,000 deficit. You're like, woo, man, what's going on there, right? Well, this column here is what the IRS wants to know. This is very much the same as the front page of the IRS Form 990. The question the IRS is asking is, how much new money came into Homeboy Industries in 2015? The IRS accounts for money in the year that it was pledged. Whether you received the cash or not, it doesn't matter. If someone said, I'm going to give you $100,000, Homeboy has to record that in the year that it was pledged, regardless of when they received the cash. So what the IRS wants to know in our financials total column is getting at on our financial statements here is how much new money came into the organization, either pledged or received in 2015. Now, from the accounting perspective, from the IRS perspective, 100% accurate. From the question we're trying to answer, irrelevant. You're like, wait a minute, what? You're not supposed to look at the total column? Nope, that is not the column that you should be focusing in on. So what column should, why? Well, let me give you a quick little demonstration of two reasons. There's many, but I'm going to show two reasons why, in this case, the total column is not the right column to be looking at. All right, first, let's look at these grants and contributions here. And you see, if you look under the total section right here, you see they got $9 million in grants and contributions. Fantastic. Way to go, Homeboy Industries. But that's not my question. I don't want to know how much total money they have. I want to know how much was available to pay salaries and light bills, right? That's my job as an executive director, keep the organization going. And was all $9 million available? No. Why? Well, again, we see right here in the middle, 1.7 million got put into the cookie jar to set aside for next year, for 2016. So how much money did Homeboy actually have to use to pay salaries and light bills? $7,264,203, right? So they actually only had 7.2 million, not 9 million. So the first problem with looking at that total column is that the IRS is including money that you cannot use. Right? They make no distinction between these two categories. Fortunately, on audits, they do break these two categories out, which is why we're going to look at audits in a lot of this course. So that's one problem that when we're looking at in the income statement by looking at the total column. The other issue is this net assets released from restrictions. Now we're starting to get something weird. I see this negative 2.5 million here. I see a positive 2.5 million here. What's happening? Why is there this equal and opposite offsetting transaction? Well, because what's happening is they're taking that $2.5 million from the cookie jar that they received in previous years, and they're moving it over to the unrestricted pile so they can pay their expenses. And if you see here, right, there are no expenses under temporary restricted. All expenses have to be paid with unrestricted dollars. So they took the money out of the cookie jar over here and they get to use it. But all of a sudden you see zero here. Why is it on the accounting? Why is it zero? Because remember, this money was received and accounted for in previous fiscal years. And in fact, if we look over here on 2014, what do we see? Last year, the organization received $2.5 million into the cookie jar. And then they went ahead and released $2.5 million in 2015. Now, these numbers don't match exactly because there's other things that are coming in and out of that as the year goes on. But you can see the numbers line up pretty well. And so what's happening is the money comes in 2014, the IRS accounts for it's there, right? Check, we account for it. Then Homeboy goes to spend it in 2015. The IRS says, well, good for you. We're not going to count it because we've already accounted for it in the previous fiscal year. So the second problem with looking at that total column is that the IRS ignores money that you can use. First, it includes money that you cannot use, and then it ignores money that you can use. You're like, what is going on here? Crazy town, right? So where you need to focus, where you need to be paying attention to is the unrestricted column, the without donor restrictions, because that is telling you how much money you really have to pay salaries, light bills, and operating expenses. So in this case, you see that the total amount of money that was available to Homeboy was not 16.2 million, which is what you see in the total column. It's the 16.9 million that you see in the unrestricted column. So they had $16.9 million of revenue available, but they still only had 16.5 million in expenses. So did Homeboy bring in enough unrestricted revenue to cover its operating expenses? Yeah, big time, right? They actually had an unrestricted surplus of $478,000. Oh, I wish my numbers looked that good, right? So I look at the total column, I see a deficit of 300,000. I look at the unrestricted column, I see a surplus of almost 500,000. You're like, whoa, those are two very different numbers, right? Are you going to be making different decisions depending on which data point you're looking at? If you think Homeboy has a deficit, you're going to make a certain set of assumptions and decisions. If you recognize that in reality, they brought in more than enough money to cover their operating costs, you may be making different decisions and different assumptions. Same exact income statement. I didn't do any magic. I didn't move things around, right? I just said, do you want to look here or do you want to look here? So depending on where you look, you're going to get very different answers. The reality is, as leaders, as managers, as people who work in the nonprofit industry, you have to pay light bills, you have to make salaries, you have to cover operating and programmatic support. What we're concerned about is this number, this total revenue that is unrestricted. Because if it's unrestricted, that is what's available to cover our operating expenses. So first takeaway from this program, focus on the unrestricted revenue. That tells you your true operating performance. The total is the accounting. That's what the IRS and the accountants and the auditors need to know. That is not management data. That doesn't tell you how much money you actually have available. Because remember also, revenue does not equal expenses. I mean, revenue does not equal cash, right? So the total column really is the accounting. The unrestricted number is our management data. So as we go through and you're looking at audits and you're going to be doing your financial assessments for your final project, make sure you're paying attention to the different columns and understand how the organization is really doing. All right. So a couple of key takeaways, right? Understand that difference between total revenue, what the IRS needs, and unrestricted revenue, what you need to know. And then remember, revenue does not equal cash. Remember, we talked about that accrual accounting. When we look at Homeboy next week, you're going to see that a lot. I'm going to go back actually a slide. A lot of this revenue that they actually have is in the form of IOUs, right? It's pledges to give. They don't actually have the cash, but we're going to get into that more next week. So revenue doesn't equal cash. The same thing. Now we're going to talk about budgets in a couple of weeks. But when we think about putting our budgets together, we also need to make sure, are we including our unrestricted cash or are we including restricted cash or restricted revenue in our budgets? Because that doesn't help us. If the money comes in 2022 or 2022, but we can't use it till 2023, that doesn't help me make payroll this week, right? So focus on those unrestricted numbers. All right. That's it for this week. Nice and short and sweet, right? So the homework assignment, I love this. Forum discussion. If you haven't seen this video, I love this video, right? Everyone deserves a fair slice. It's from the Human Services Council up in New York. And if you might want to actually go back and watch the Dan Pallotta video and watch this video together, because they have very different takes, or they're trying to emphasize the same point, but they have very different takes on it. So when we talk about this, and we talk about this concepts of like restrictions, right? Should donors be allowed to restrict their contributions, right? Especially when it becomes limiting how much overhead they have. So, should that be something? We can't do it in the for-profit world. We're not allowed to do it there. If I go in Starbucks, I can't restrict those dollars. So why should I be able to restrict dollars out for a homeless shelter, right? So do you agree that funders shouldn't keep funding the same organization so that the nonprofit doesn't become dependent upon? You hear this, foundations, oh, after 2 or 3 years, you got to take a break because, we don't want you to be dependent upon our revenue. I had a board member once at a funder in Oregon ask me, like, I think one of our nonprofits, there's something broken with their business model. And I'm like, why? Well, they keep coming back to us every year asking for money. I'm like, really? Wow. I hadn't thought about that. Starbucks, their business model must be broken too. They keep coming back to me and asking me to pay for their coffee. I don't know what I paid for it I paid for it yesterday. Why should I have to give them more money today? Right? No. For-profit businesses survive by getting customers dependent on them. That's the for-profit business model. Repeat customers, right? You look at car companies, you look at Amazon, you look at things, they survive by having customers come back and keep buying products and services from them. You don't buy just one cup of coffee from Starbucks and never go back to them again. Well, I don't want Starbucks to become dependent on my revenue. That is not how the world works. But somehow we go down this wacky world of nonprofit finance, and all of a sudden people are like, oh, we don't want them dependent on our money. And I'm like, why not? Every other for-profit business in the world is dependent on repeat customers, right? But in the nonprofit sector, somehow we think nonprofits can survive without repeat customers. Where that came from, maybe you disagree with me. Maybe you feel like, yes, that is the proper way to do it. It forces financial, rigor. It doesn't make them lazy. It makes sure they're keeping out there, getting other funders and other donors. They don't become complacent and just think that we're just an ATM that every year we're going to give them more money. That's one approach. I wouldn't call that a trust-based approach to philanthropy, but it is an approach. So in the forum discussions, what do you think? I'd love to hear what you have to say. Then we have a quiz, hopefully not too brutal, but I really want to reinforce some of the key concepts that we've talked about today. And so in the online, you have the statement of activity, the income statement from Tree People. And the audited statements are provided online. And then you'll have 10 questions that you'll need to answer regarding the Tree People statement of activities. And so your quiz, you can grade it, and then you'll see the answers right after that. Then we're going back to Flipgrid. One of the things that I really love about this audit from Homeboy Industries in 2015 is that they put this cover letter, what they call their financial commentary, which is a 2-page cover letter on top of the audit. So I'd like you to go and read that cover letter, that management, what do they call it? The financial commentary, right? Because what Homeboy is actually trying to do there is they're like, hey, we know what the accounting is saying in the audit. We're trying to give you the management view. And so what they do is they talk about how they did, but from more of a managerial perspective. What do you think? Do you think it's effective? Does it just confuse you more? Does you think that what Homeboy does in their cover letter provided a more accurate kind of representation of their financial picture than maybe the audit did? No, we'll see. So go ahead and then, post your kind of thoughts, and then also make sure that you respond to 2 of your peers in terms of their thoughts. Well, that's a good point, or I disagree with you, or I agree with you. Please be respectful, of course. But I'd love to hear what people think about this, because it's actually one of the things I love about this audit in this example is that financial commentary, because I wish more organizations would actually do that. So you can tell where my bias is right there, right? All right. And then next week, balance sheets. Oh, yes. This is going to be my favorite the favorite week of the entire program. And hopefully you'll enjoy it too. So this ability to handle risk or pursue opportunity, the balance sheet. In Street Smart Financial Basics, check out chapters 5, 12, and 20. I'll do another highlights next week for the balance sheet. And then there's a couple articles and videos that I think are going to be really, really helpful. The balance sheet is probably, it's the most important financial document, but most things it's one that people understand the least. So I've had a bunch of different resources here to help folks. Maybe one of these helps explain it in a little clearer way than some of the others. So take a look at some of the videos. There's a couple articles there, and kind of start to understand really the importance of the balance sheet. So that's it for today. That's it for this week. I hope you enjoyed our little highlights video for today. And again, as always, if you have questions or concerns or something that that made no sense to me whatsoever, reach out to me and I'll get back to you as soon as I can. All right. Have a fantastic week. Thank you.